Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our guests on the show today. Joining us today are Vivek, Mavani and Sharmila, Joshi, who are independent investment advisors, and T.S. Harihar of HRBV Client Solutions. Many thanks to my guests for joining in today. On the show today, we discuss the results of Reliance Industries. It was a subdued quarter with weakness in the core business as well as weakness in Jio. What's in line for them? Now that the four big IT companies have come out with numbers, which among the four is the best and what's the pecking order post the third quarter results? Tech M obviously will come out with numbers at a later stage. We ask our analysts about one stock that they would like to play on the agri theme now, given the fact that a lot of stocks, including Reliance, came out with very strong numbers and very strong commentary. So most of the agri stocks have started to do well. And lastly, we discuss Page Industries and whether the rebound in the stock will continue. It's again come back to levels of almost 26,000. So what's the view on Page Industries? But let's start first with the big one, that is Reliance Industries. The counter hasn't moved much. In fact, it's trading slightly soft. It's down almost 2% today. Weak petrochemical numbers. Jio was weak. The ARPUs for Jio were weak. Refining was okay. Retail was okay. But no major fireworks that came in on Reliance. So what's the view on Reliance going ahead, and what should one do on the counter? So, Hari, first of all, what did you make of the numbers? Would you recommend someone to make a bet on Reliance post seeing these numbers for the near term?
See, I think we need to look at it in the right perspective because, Reliance is obviously no small company. If you look at the market cap of $120 billion, huge sales, 12,000 crores of profits every quarter. So we are talking of a very, very large company in the Indian context. So obviously, I think quarter after quarter growth in this kind of a cyclical industry is going to be tough. But if you break down the numbers, I think in my view, more positives than negatives. And let me just explain why I'm saying that. I agree that petchem margins were probably the biggest stumbling block, and telecom growth was a little slower, but I think that is understandable. The positives I see are about two or three. Number one, if you look at the gross refining margins, I think it was about $9.4 or 9.5 per barrel, which although it is less than $10 that the markets are estimating, I think it is still substantially higher than what the Singapore benchmark had reported. So, we still have a Reliance that is reporting a huge premium to the Singapore benchmark. So that is, I think, one part of the story. The second is the retail, which is anyway good. But even if you look at the telecom business, I think what's important is that the ARPU is about 128 rupees per user, which is slightly larger than what it was in the last couple of quarters. And if you look at the growth, for the first time in 8 quarters, we had 7 quarters of ARPU falling, and for the first time we have had an ARPU rising in this quarter. So I think the good news seems to be that all these price hikes and everything seems to have led to a bottoming out of the ARPU. So in my view, from the futuristic perspective, GRMs are safe, telecom is safe, retail is growing, petchem is probably the only worry. My only concern on Reliance is at a macro level that most of the good things about Reliance, I think, are already in the price. So expecting great outperformance is going to be difficult. But yes, I don't see any great downside risk on the stock at these prices.
The management has said that the Aramco deal probably will be delayed. Is that a dampener that the market is probably fearing?
No, that was expected because I think a $15 billion deal was anyway not going to happen by March. I think that was more or less factored in. And anyway, I think the government wants them to give clarity on the penalties that they and BP need to pay before they, approve the deal. But I think that is more a question of when rather than whether. So probably instead of March, it may happen in June or July. But I don't think that should really be a concern as far as investors are concerned.
Okay, that's the view that's coming in on Reliance. Vivek, what's your sense? What did you make of the numbers? What's your fundamental view for someone who wants to take a position in Reliance?
Well, I think the stock is quite a sort of in a neutral territory and not really a price which gives a risk reward which is attractive to take a new position, assuming somebody doesn't have a position. One would wait for the declines. Now, 2-3 things, as you mentioned in your opening remarks, or the larger issue, taking from what Hari mentioned. In the traditional business of Reliance, oil and gas, refining and petrochemical, it's too large to really be, I would say, being able to outperform the global macro scenario as far as the oil and gas and petrochemical business is concerned. So globally, if that business is itself growing in low single digits or at best high single digits if crude prices are higher, it's doubtful whether Reliance on a long term can outperform or outbeat that growth rate on for a very long time. They have done it in the last several years, but I don't think they can keep doing it forever. So petchem, the weakness in petchem business may probably be much longer than one may envisage. Only good thing is petchem is a very serious cash cow for Reliance, which actually has been funding all other businesses in the last 20 years. And that although earnings growth or profit growth in petchem may be muted, it will still provide very healthy cash flows which will continue. So the same point can be said for refining business as well. Growth may not be very large. Margins, gross refining margins could remain at a premium to international benchmarks, but it will provide very steady cash flows. But growth is going to be a question mark on it cannot really deliver a double-digit growth that all of us would expect from a typical Indian company. I mean, nobody's excited about 4-5% profit growth for any Indian company. That's one. So that leaves us with two new growth engines, retail and Jio. Jio, as far as the digital business is concerned, incremental or future growth is going to be led by price increases, A, and B, charging of services which currently are provided free. Like Jio Fiber has been rolled out, but they don't really bill it, or there is not much of revenue coming in, which hopefully will happen only next financial year, because no indications that billing is going to start even in the current quarter. I mean, we are almost down with 1 month and no indication that's going to happen. So the new services where revenues will kick in probably next year, and only price increases will be led by growth, because volumes in terms of subscribers, unless there is a en masse movement away from Vodafone Idea subscribers shifting to Jio, I think more or less the subscriber side of it is more or less evenly balanced. Last couple of months, in fact, for the industry as a whole, including Jio, there have actually been loss of subscribers. So a lot of people who took the second SIM in the last couple of years probably are giving up the second SIM and having only one. Where, I mean, otherwise, what explains the reduction in number of subscribers in the last few months that we have seen? From a valuations point of view, for the current state of the corporate structure of Reliance, I think they are fair. I don't see too much of an upside in terms of expansion of valuation multiples in a significant manner. It's already happened in the last 2-3 years. I don't see anything further. The big trigger, of course, would be eventual value unlocking and demerger of the digital and the retail business at some point of time. The Aramco deal hopefully will happen in the next financial year, and so the whole deleveraging story which was around Aramco deal will happen only in March 21. So right now, I think it's a no trade area.
Okay, that's the view that's coming in. Sharmila, what's your sense on the numbers? What did you make of it?
Yes, I think I would agree with Hari when he said that from their traditional business, that is petchem, the numbers there were tepid. But I think, very honestly, off late, because that part of the older part of the business tends to be a cyclical business, I think people understand by now, the push and pull that there is for such a business. So if you are in a scenario where crude prices are high, I think obviously that would get factored in. So what market has been really looking at very actively is how the retail business does and how Jio does. Because all said and done, when you have such free cash, if you have such great cash flows every quarter, you need to be invested in businesses which begin to show that growth. New age businesses, other than the old traditional businesses, and they got into retail some years back. Now we are seeing that it is doing well for them, and I think in this quarter that was probably the standout performance, the way retail has done, and the plan that they have going ahead over there. So I think that's very heartening. Where Jio is concerned, yes, they have now emerged as the number one in that space. They have the most number of subscribers, and I do think that they have laid the ground now. With everything that they've done, whether it is with Jio Fiber, whether the way they've done their pricing, everything that's happened in the telecom industry to do with AGR, all those issues, I think that now they have laid the ground for that IPO, and hopefully this year, if market conditions remain benign, we will see that IPO, and that could be a value unlock for Reliance. So I'm neutral on it because my target was closer to 1650 and we've sort of corrected from there. So I'm neutral for now, but really I think nothing in the results really to either excite you too much or disappoint you too much.
Okay, that's the view that's coming in on Reliance Industries. The second one is basically the IT sector, because the four large companies in this sector have come out with numbers, while TCS and HCL Tech have reacted very negatively to the numbers. You have also Infosys, which is down. So HCL Tech not as bad as TCS. TCS is down almost more than 2%. What's the pecking order? Are the signs that have come in from the second quarter earnings decent, or is it a sector that you would stay away? Vivek, now that 4 numbers are out, how do you summarize the IT sector? And if someone wants to play the IT sector, what's the pecking order?
Well, so for me, it is Infosys and TCS continue to be the preferred pick, and Wipro being the least preferred. I mean, Wipro has been struggling to get its growth back for a long time. I mean, it's been almost more than 5 years that Wipro has been struggling to grow, and among the 4 companies, Wipro has been a sort of laggard when it comes to delivering on growth. They have tried a lot of things. I mean, they continue to take initiatives to give credit to the management, but we somehow don't see it in the numbers from that point of view. Infosys preferred pick from the growth momentum is back, high single digits, low double digit growth. I think for the next couple of years seems to be a given, along with obviously the free cash flows and the dividends that Infosys pays out. So even now at 764 as your screen shows, I mean, it's a 3% dividend yield stock. Last year they paid 21, and probably this year it should be little higher, maybe 10-15% higher dividend. So 3% dividend yield itself would be a margin of safety in terms of downside, even if they were to disappoint for a quarter here or there, but it's unlikely. I think they've got their growth piece right in under the new management from last year. TCS, after a long time, has on a quarterly basis disappointed, but again on a longer term basis, I mean, you can't really find too much of negatives in TCS, although valuations also are higher or significantly higher than the other 3 companies, simply because barring the latest quarter, I mean, they've been delivering industry leading growth rates. My sense is, over a medium to long term, give or take the 1 or 2 quarters of hiccups, I think medium to long term TCS could also continue to deliver high single digit, low double digit growth in terms of earnings. TCS, again, if one were to look away from the earnings, I mean, all of us are focused on earnings, and probably a 10% or 12% growth doesn't excite us. But a 2.5-3% dividend yield for some of the largest companies, including nifty companies, I mean, these are outliers in which, to me, notwithstanding the higher valuation at maybe 23 or 24 times that TCS is versus maybe 18 times for Infosys, I still don't see significant downside in TCS unless they're going to cut dividends and they're going to cut buybacks and just be hoarding cash, which is unlikely, because the cash will eventually will be returned to the investors, and hence the margin of safety from the dividend point of view, even for TCS, about 2.5 to 3% will sustain. The last being HCL Tech, surprisingly, and it now surprises me after 15-18 years that they have been outperforming in terms of growth rates to other IT majors, but yet has always traded at a significant discount to the Infosys and TCS. Even in the worst time of Infosys, when they were having management issues and growth issues, even that time HCL Tech was still at a marginal discount to Infosys, for which at some point of time I find it difficult to understand and explain as to why HCL Tech should always have that discount. But I think if they deliver quarter after quarter, if they continue to deliver and start paying out as much dividends as Infosys and TCS does, I think the discount factor will narrow for HCL Tech.
Okay, that's the view that's coming in. TCS Infeed picks that Vivek likes at this point of time. Sharmila, your sense on the IT results, how did you review them? If someone wants to take a bet, which is the better of the 4 and which one is the avoid? Yeah,
so first of all, I must say that on Bloomberg there's a very good story. I think Agam's done a story which has compared all the 4 numbers. I think that's a very good story to read. I think for me the clear, there are 2-3 parameters that you need to look at IT numbers that. One is, I think, of course, in Infosys, for me, the standout was the digital area performance. So digital as a business vertical has performed extremely well for Infosys in this last quarter, and it will, as even the management has indicated, is really going to take it from here in terms of growth and contribute even more to earnings. So for Infosys and HCL Tech, what we found is that the financial services division, which used to be like their mainstay sort of business, that has done considerably better than what it has done for TCS. So for TCS, in that sense, that business has not really contributed as much, or it's been slightly on the lower side as compared to these 2 companies. Then again, I think that when you look at the kind of revenue guidance improvement that the companies have done, possibly that has been the best for HCL Tech, followed by Infosys, and I think TCS was extremely tepid, and I think Wipro has disappointed the market on that front. So I think when you look at it from a valuation perspective, and the fact that where the growth is coming from, and the fact that for the longest time I have liked HCL Tech as a play, because I do see IBM contributing increasingly to their revenue stream, and that again played out in the numbers this quarter. And we saw that because of the IBM contribution, their margins in fact look better. And I think even in terms of as I said, the revenue guidance that they've given, probably the best improvement, in terms of the upgrade was the best in HCL Tech. And the fact that it trades actually much cheaper than both Infosys and TCS, HCL Tech would continue to be my favorite stock, followed by Infosys, then TCS and Wipro. But that said, I think maybe in terms of just stock price return, probably Infosys could give you better returns here, because it is emerging from that whole that whistleblower issue. So maybe you could see better returns there. But from a longer term perspective, I continue to prefer HCL Tech over the others.
Okay, HCL Tech is the preferred choice. So what's your sense on this entire sector, Hari?
So I think clearly, our preference is for Infosys. That is our top pick. And to understand why, we need to look back at Infosys versus TCS over the last 5 or 6 years. So if you look at Infosys versus TCS from 2013 onwards, that was a time I think the market cap of both the companies were almost the same. Now, over the last 6 years, TCS has actually become twice the market cap of Infi, largely because they had better operating margins, they had better growth, and they had lower attrition. I think growth is now shifting. Growth is shifting from TCS to Infosys, because TCS was flat and Infosys is guided for about 9.5 to 10.5% growth. So I think that definitely works in their favor. Margin wise, still, TCS, if you look at it, even this quarter, which has been bad, they've had a 25.2% operating margin, so which is amazing. But having said that, I think Infosys is catching them. So there again, I would believe that Infosys does a better valuation play compared to TCS. Attrition, I think, is one area where Infosys still needs to work on, because I think still it's about 18-19%, which is fairly high if you look at the competition. So that is one area they need to work on. But probably, last 5-6 years, because of all these, Vishal Sikar related issues and management churn, that could be one reason. And I think with that stabilizing, we should see that gradually reducing. So clearly, our top pick would be Infosys. We believe that TCS, a lot of the short to medium term potential of the stock is already factored in the price. So we don't see a much of an upside. We like Tech Mahindra, but then since they have not announced the results, we'll probably wait for the numbers to come out before giving a view on that. But if I look at the pecking order, for us it is Infosys followed by Tech Mahindra.
Okay, that's the view that's coming in. Infosys is the top view from Hari. So that's the view that's coming in. Agri as a theme has done well. Of late, we've seen some of the counters move up significantly, especially after Rallis gave out very, very strong set of numbers and commentary. What's the view? Is there any theme on the agri side that, and obviously budget is coming up, so most of the fertilizer chemical stocks have started to do well. Sharmila, anything on the agri theme that you like?
I'm going with PI Industries.
Okay.
So as you say, one is of course the fact that you're hearing about this, the whole urea story and all that, which I'm not particularly really tracking that closely. So I'm going with PI Industries simply because I liked it from a numbers perspective. If you saw the last quarter numbers, they were an extremely strong set of numbers. And even going ahead, the indications are very strong, because what we are really seeing is that they're launching a lot of new products in this year, and that will increasingly contribute to their top line, and the fact that they are that way now an export oriented story. So in the crop protection space, I think the numbers that they've got, the margins that they've got, make this a good stock to look at. I do think that the valuations are a little high, but let's wait for the numbers, and I think this could very well be a stock that looks good to me from this pack.
Okay, Agri PI Industries. Hari, what's your sense? Which counter do you like?
Well, we like UPL. Again, I think a very, very focused play on the agrochemical space. Phosphatic is their, I would say, largely predominant theme. And if you look at the stock has been under pressure for the last 1.5 years since they did their Latin American acquisition. And the reasons are not far to seek. I think it led to a $2 billion accretion in debt. There are questions about how much the acquisition would contribute to revenues. I think those questions are now being answered. So what we understand is that the stock is already corrected about 25-30% from the peak. And at these levels, to me, the downside risk seems to be quite limited. Also, if you consider the fact that the overhang of debt which they had taken for the acquisition, I think that should get compensated by the accretion in revenues from the acquisition over the next 3 or 4 years. So short term, I would believe they may be under pressure, but medium to long term, we believe that UPL has a lot of value in the stock.
Okay, UPL is something that is there, PI Industries, UPL, and which stock are you liking in this space?
Yeah, so I'm going to go with a tractor story, and a proxy for tractors. For me, one of my preferred pick has been Swaraj Engines. I already have an investment for myself as well as on behalf of my clients. So basically, Swaraj Engines is a Mahindra Group company, supplies tractor engines to the Swaraj or the part of the business, what used to be erstwhile Punjab Tractors, now under the Mahindra fold. So this company supplies those engines, single buyer in terms of Mahindra, which holds 35%, 17% is held by the Kirloskar Group. Very transparent transfer pricing mechanism between Swaraj Engines and Mahindra, and absolutely no issues in terms of cash flows. So this is a rare, I would say, auto ancillary which has balance sheet which has attributes what one would see in a Hindustan Lever or a Nestle or any of the consumer names. 80% of the balance sheet is cash and cash equivalents even now, after they had done a buyback last year of 70 crores at 2,400. Stock price is less than 50% of that. I mean, they had done it in 2018, February of 2018, I'm sorry. So it's almost 2 years now. I'm sorry. Dividend payouts are like 90% of profits are paid out as dividends, and yet the balance sheet is full of cash. Dividend yield in Swaraj Engines is upwards of 4%, close to 5%, which itself gives margin of safety. From a growth point of view, all of us are familiar with decline in volumes in the auto sector, but two things. Mahindra itself has seen only single-digit decline in volumes in tractor business in the last 12 months, so calendar year 2019. Importantly, Swaraj Engines itself has seen only much lower decline in volume. So what we are referring to is the contribution of, Mahindra is sourcing more from Swaraj than maybe their in-house supplies as well. Significant headroom for growth because they've expanded capacity 2 years ago, which of course is not utilized. So currently they're doing about 95,000 to 1 lakh engines a year, capacity being 1,50,000. So significant headroom for growth before the next expansion is required. Return on capital, return on equity, very healthy at upwards of 35%. In fact, if one adjusts for the surplus cash and other income, then the business return on capital is well over 100%. Trades at about maybe 17, 18 times earnings, about 10, 11 times EV by EBITDA. To me is like pretty cheap for the kind of numbers that Swaraj Engines and pristine, clean business and balance sheet. So continues to remain my preferred pick even now.
Okay, and we have time to just slip in the last one, that is Page Industries. The count has rallied significantly back close to now, back to the 26,000 mark. Are things turning for Page Industries? What's the view ahead? Hari, quickly, Page Industries, are you concerned about the valuation, or now are you seeing growth coming back?
No, we still continue to be concerned because I think the rally happened a little too fast. And if you look at the price, it's rallied almost 52% from the low. So I think that's quite a bit of a rally in a short span of time. And if you look at the valuation, I think it's about 75 times earnings compared to the industry average of about 34 to 35. So I think valuation still doesn't give us comfort, and I would at least prefer to stay off the stock for the time being.
Okay, prefer to stay off. Vivek, your sense on Page Industries?
Well, these valuations certainly are not justified for the kind of growth slowdown that Page has seen in the last few quarters. I mean, so at about maybe 65 times earnings or 60 times earnings forward, whatever 10% growth that one may assume for in future, certainly these numbers don't justify the valuations. I mean, these valuations will be justified if it was going to assure you 25-30% earnings growth for the next 5 to 7 years, which until recently people did assume until about maybe 4 to 6 quarters where a serious slowdown has hit them. Number one. Number two, competition is also catching up fast, denting their EBITDA margins. So some of the other foreign brands like Fruit of Loom or even domestic players getting into the premium segment that Page Industries is. So for example, Aditya Birla has under Van Heusen also launched innerwear And Page has, as a result, in the last couple of quarters, seen some dent on EBITDA margins because of competition. So I would certainly not be a buyer, notwithstanding that it's rallied 40% from the 52-week lows. But it is still, by the way, 30% lower from the all-time highs done 2 years ago. So I would still stay away from it. Valuations just don't justify it.
Okay, what's your sense on this, Sharmila?
Yes, so I think I would agree, and I think that what we really saw was that last quarter, a lot of meaning we had been seeing a gradual slowdown in the kind of earnings that they were doing, but I think last quarter a lot of things caught up with them, and I think the numbers were a bit of a shocker. I mean, really not a great set of numbers, and we saw the stock correct from there. So I think yes, the kind of rally that is being given seems too fast, too soon, because I don't know on what basis, because obviously the slowdown in the consumption story is real, and we don't know whether things are looking up for Page Industries. So I would say wait and see what the numbers are like, and then take a call. But at present, the current price that it's trading at, the valuations just seem too high. So as I said, I'm neutral and I would wait for the numbers.
Okay, that's the view that's coming in on Page Industries. With that, it's a wrap on today's edition of Hot Money. Let me thank my guests who've come in today. Sharmila, Vivek and Hari, thank you so much for coming in today.
Thank you.
Ask BQ comes up next. Stay tuned to BloombergQuint.